Yes, people, good morning, good afternoon, good evening to all South India student. How are you? Hope so you are good. I am also good. So guys, today we are going to start with our last topic of the syllabus, that is the MTC, or you can say that the Model Text Convention. Now first is, sir, what is the meaning of convention? So convention means, guys, if you heard about the DTAA. So we have discussed the topic number 3 was, I think, DTAA in the international taxation, and in the topic number 3 we have discussed about the double taxation avoidance agreement. So if you call double taxation avoidance agreement, or suppose if you call the tax treaties or tax convention, all three are same. So tax convention or DTAA, or like your convention, tax convention or DTAA or tax treaty, everything, all three are remains same. That is called your DTAA. Now guys, here we are going to discuss model. Now what is the meaning of the model? So model means basically, what is the meaning of model? So model means, I can say that there is a performer or format is called model, na? Suppose for an example, you have started your practice after completing the CA, and one client came to your office and client says that, okay, I want to draft a partnership deed. Now what detail you will ask? So obviously you will ask, okay, give me your name, your partner name, your PSR, that's it. All information related to the partner, your PSR, as well as your remuneration interest. And what you will do? You already have one format. You already have one model of the partnership deed, and you will just put the detail in that model and there will be a partnership deed. So now question is that, sir, for an example, our India's Prime Minister Narendra Modi, and suppose Italy Prime Minister, or like a Prime Minister that Meloni ji, suppose Meloni ji and Modi ji, they came together and they are sitting in one table and they decided that, okay, we will enter into the double taxation avoidance agreement. So question is that how they will write the double taxation avoidance agreement. Obviously there should be some model, na? Obviously there should be some format, predefined format, and whatever changes they require, they can do the changes in that particular model. So guys, we are going to discuss the model tax convention. And basically there are three models available in the market. One is the OECD model, one is the UN model, and one is the US model. Now OECD model is basically followed by the developed country. So suppose one developed country is entering into the agreement with the another developed country, then they will follow the OECD model. And in the OECD model, basically OECD model is always say that taxing right will always be with the resident country. Resident country means, suppose for an example, if any person is a resident of one country and he is earning income from another country, then OECD model always say that basically main right on the taxing the income is with the residence state, not with the source state or source country. So that is the OECD model. Now there is a one more model that is called UN model. Now UN model always give the balance. Like they are saying that suppose if income source is located in one country, then that country also have the right to tax such income. And residence country also have the right to tax such income. So basically UN model is basically balanced model, and one is the US model. Now US model is basically followed only by the US. Whenever US entered into the agreement with any other country, then US always follow the US model. So there are three models. Now question is that which model India follow? Because suppose India entering into the agreement with any country, then India will follow the UN model. Because we are part of the UN, na? We are part of the United Nations, so we are part of the UN, so we normally follow the UN model. So let's start with this topic. Very simple topic, very easy topic, and in examination you may find the question from this topic is 4 mark. And this 4 mark question either from the model tax convention or tax treaty or your BEPS, that is base erosion and profit shifting. So out of 3 topic, one question you will get 4 to 6 marks question in the examination. Okay, so let's start with this topic. OECD model. OECD model is basically essential model treaty between the two developed nations. So two developed nations enter into the agreement and they follow normally OECD model. This model advocates the residence principle. This model advocates the residence principle means they are giving the more right to the residence country. This is emphasis on the right of state of resident to tax the income. Now second is a UN model. UN model is a compromise between the source principle and the residence principle. However, it gives more weight to the source principle against the residence principle of the OECD model. UN model is designed to encourage the flow of investment from the developed country to the developing country, and it's take into account sharing the tax revenue with the country providing the capital. So country providing the capital is a residence country, and guys, suppose that business is in another country, that is called source country. So they're giving right to the source country as well as they are giving right to the residence country. Now next is the US model. Now US model, this model convention is used by the United States while entering into the tax treaty with various countries. So whenever US is like, you know, that is the power of world, and US enter into the any agreement with any country, then they follow the US model. Now guys, OECD model contain basically 7 chapter comprising of the 32 articles, and UN model also contain the 7 chapter but comprise the 31 article. So in UN model there are 31 article, in the OECD model there are 32 article, and guys, in the US model there are 30 article. So US model 30 article, OECD model 32 article, and UN model 31 article. Now article, what is the meaning of article? Article means you can say that the topic. Article means you can say that the topic. So always article number 1 in every agreement is a person covered. Article number 2 is related to the taxes covered. Article number 3 is basically related to the definition that is not covered in our syllabus. Article number 4 is related to residency. Article number 5 is related to the permanent establishment. Article number 6 is the income from house property, but that is not there. Income from house property, article number 6 is I think not part of our syllabus. Direct article number 7 is part of our syllabus. So guys, if I show you any DTAA, so let's see DTAA incometax.gov.in. Now on the income tax website, in the international taxation, if you see any tax treaty then you will able to understand. Oh, so here guys, tax treaty, or you can say that international taxation, DTAAs, double taxation avoidance agreement. So I just want to show you one exhaustive agreement, comprehensive agreement, and comprehensive agreement with suppose Bangladesh. So with Bangladesh we have the comprehensive agreement. Now in this agreement there are various articles. So article number 1, you see it is a personal scope, or you can say that person covered. Article number 2 is related to the taxed covered. Article number 3 is related to general definition. Article number 4 is related to the resident. Article number 5 is a permanent establishment. Article number 6 is related to immovable property rental income. Article number 7 is related to business profit. Article number 8 is related to the air transport. Article number 9 shipping, associate enterprise. Article number 10, after that article number 11 is a dividend. Article number 12 is a interest. Article number 13 is a royalty. Article number 14 is capital gain. So guys, article means you can say that the topic. So suppose for an example, our Modi ji from India and from Bangladesh PM, suppose they sit on the table and they want to make the agreement. So how they will make the agreement, how they will start the agreement? So they always take the help of the model. And there are 3 models. One is the OECD model, one is the UN model, and one is the US model. Normally India is the UN country, so we always follow the UN model. So let's start with one by one article, okay, what is written in that particular article. So guys, article number 1 is very simple article, and that article number 1 is related to the persons covered. And article number 1 in both the model, in the OECD model as well as in the UN model, it is related to the person covered. So OECD and UN model convention would apply to the person who are resident of the one or both of the contracting state. So guys, this DTAA, suppose when DTAA is entered, so DTAA will apply to only to the person who is the resident of either one state or both the state. Now for an example, India and Bangladesh convention. So in the India and Bangladesh DTAA, in this DTAA, if you see the article number 1, and article number 1 is very simple article. What this article number 1 says, that is the personal scope. And this article says that this convention means this agreement, this DTAA shall apply to the person who are resident of one or both the contracting state. So article number 1 in the UN model as well as in the OECD model, in the UN model and as well as in the OECD model, guys, that is related to the like person covered, and that it is written in this particular article that this convention is applied to the person who is resident of one or both the contracting state. Now guys, in our syllabus that US model article is not there. Only US model they have mentioned that US will enter into agreement with any country, then they follow the US model. Only this much is covered in our syllabus. Otherwise, whatever article we will discuss now, then they will only talk about either UN model or like OECD model, or what are the differences between the both the model, that is like mentioned here. So this is the article number 1. Article number 1 is related to the person covered, and article number 1 says that basically in the OECD as well as in the UN, both the like MTC, this is the common article, or you can say that identical article. And this article says that DTAA is applicable to the person who is the resident of one country or both the contracting state. So India and Bangladesh agreement is applicable to the person who is the resident of India or resident of Bangladesh or resident of both the country. Now guys, that what is the meaning of this fiscal transparent entity and all? Wait some time, I will explain you in the later part. Next, article number 2. Article number 2 is related to the taxes covered. In every agreement, in the every DTAA, normally article number 2 is related to the taxes covered. Which taxes covered here? Is only income taxes covered, or is wealth tax is also covered? Because normally DTAA is related to the direct tax, and in direct tax there is a income tax as well as the wealth tax. But in India nowadays there is no wealth tax. But you know that 10 years ago there was a wealth tax in the India, but now there is no wealth tax in India. So what article number 2 says? Article number 2 says that taxes on income and capital. Model tax convention apply to the taxes on income and on capital imposed on behalf of the contracting state or its political subdivision or the local authority, irrespective of the manner in which they are levied. So article number 2 says that model tax convention is applied on the taxes on the income. So taxes on the income means income tax, and taxes on the capital means wealth tax. So taxes on income means income tax, and taxes on capital means wealth tax, and that is imposed on behalf of the contracting state or its political subdivision. So political subdivision means there may be possibility in India. Normally there is an income tax. Income tax is charged by the central government, but there may be possibility that income tax is charged by the subdivision. Political subdivision means, for an example, state-wise income tax is charged. So it is applicable for the like income on the income tax that is charged by the contracting state or the political subdivision or local authority, irrespective of the manner in which they are levied. Now, element of income and capital includes gain from the alienation of the property, like capital gain is also covered here. Total amount of the wages or salary paid by the enterprise, that is also covered here. Capital appreciation, wealth tax is also applicable. It shall also apply to identical or substantially similar taxes imposed after the date of signing of convention. So guys, in the article number 2, if we see the India-Bangladesh article, so in the India-Bangladesh treaty, this is the article number 2. And guys, in the article number 2, if I like show you here, taxes covered. Which tax is covered? So the existing taxes to which the convention shall apply are, in case of the Bangladesh, the income tax, that is Bangladesh tax is covered. And in case of the India, the income tax including any surcharge thereon or any surtax hereafter referred to the Indian tax, that is covered. So guys, in the India-Bangladesh article, in the India-Bangladesh DTAA, wealth tax is not covered. Wealth tax is not covered. So normally in the article number 2, they always mention that which taxes are covered in this particular agreement. And both in the OECD model and as well as the UN model, this article is identical, or I can say same. So article number 1 is related to person cover. It is same in UN model as well as the OECD model. Article number 2 is related to the taxes covered. That is also same in the UN model as well as the OECD model. And in the article number 2, they mention that both countries mention that which taxes of like both the countries are covered here. Now article number 3 is related to definition, not relevant. Now article number 4, and that article number 4 is a very, very important for your examination, because examiner will ask you question from this topic now. Then there is a chance that 80% probability that examiner will ask you question from this particular article. Article number 4. Article number 4 is related to the residence. Now question is that, sir, how person will be treated as residents? So guys, in India, you know that resident, how person will be treated as resident, like an individual. So for individual in India, you know that we have discussed the section 6.1 and 6.6. There were two basic conditions: stay in India for 182 days or more in the previous year, or stay in India for 60 days or more in previous year, and 365 days or more in the last 4 previous year. So guys, as per section 6, if the any basic condition is satisfied, then that person is a resident, otherwise that person is a non-resident. Now, sir, question is that how residential status will be defined if there is a DTAA between two countries. So guys, DTAA says that, article number 4 says that residential status shall be determined as per your domestic law only. Because one person will be treated as resident of one country and obviously non-resident for another country. But sir, how we will determine the residential status? So residential status will be determined as per your tax law only, domestic tax law, like Income Tax Act 1961 in India. But sir, suppose if any person is resident of both the country, then there may be possibility na, if any person is a resident of India as well as the Bangladesh, there may be possibility. Sir, how it is possible? Suppose in India, you know that how you will become the resident if you stay in India for 182 days or more in the previous year and 365 days or 365 days or second condition is stay in India for 60 days or more in previous year and 365 days or more in the last 4 previous year. So if any one basic condition satisfied, you are resident. There may be possibility. You don't know about the law of the Bangladesh. Suppose in the Bangladesh, there is a law. If you stay 100 days in the Bangladesh, then you will be treated as resident of the Bangladesh. Now, suppose there is a one person, he was a stay in the Bangladesh for 100 days and he was in India for the, suppose remaining 265 days. Then sir, he is a resident of India as well as resident of Bangladesh. Then what will happen? Then guys, this article number 4 says that there is a tiebreaker rule. And in the tiebreaker rule, we will determine and we will conclude that that person is resident of one country, not for both the country. But how we will say that he is a resident of India or Bangladesh? So guys, here tiebreaker rule are given. Try to understand. So article number 4. Residential status of any person shall be determined as per the domestic tax law first of that country. If any person become resident of both the country, then his residential status shall be determined as follows. So for an example, there is a one person, name is Mr. Shashank. Suppose Mr. Shashank. Now Shashank is a resident of India as well as the resident of Bangladesh. Suppose Shashank is a resident of India as well as the resident of Bangladesh. Then sir, he will be resident of which country? He will be treated as resident of which country? So guys, here lawmaker says that if any person is a resident of both the country, if any individual is resident of both the country, then we will treat that person resident of the country where his permanent home is available. Where his permanent home is available, he will be treated as resident of that country. So suppose for an example, guys, here Shashank is a resident of India as well as the Bangladesh. But his permanent home is available in India, suppose. And in the Bangladesh, there is no home. Then he will be treated as resident of India and not the resident of Bangladesh. But there may be possibility, there will be one question in your mind. Yes, sir. If Shashank is having a permanent home in the India as well as Bangladesh, then what will happen, sir? If he is having permanent home in India as well as the Bangladesh, then sir, then he will be treated as resident of the country where his economic and personal relationship is more closer. Where his economic and personal relationship is more closer, or I can say that center of the vital interest. So guys, for an example, Shashank is having the permanent home in India also and permanent home in the Bangladesh also. Then we will see that where Shashank, that personal and economic relationship are more closer. For an example, in India, he is having some businesses. In India, he is having some property. His wife is stay in India. So his personal relationship is more closer in India. Then he will be treated as resident of India and non-resident for the Bangladesh. You got my point or not? Yes. So for individual, how this tiebreaker rule will work, try to understand. First point. He shall deem to be the resident only of the state in which his permanent home is available. If he has a permanent home available to him in both the contracting state, then he shall be deemed to be the resident only of the state with which his personal and economic relationship are more closer. with his personal and economic relationship are more closer, or I can say that the center of the vital interest. So he will be treated as resident of the state with which his personal and economic relationship are more closer. Now sir, second point. Okay, sir, here you mention okay, he will be treated as resident where his permanent home is available. But suppose permanent home available in both the contracting state, then he will be treated as resident of a contracting state where his personal or economic relationship are more closer. But sir, suppose he don't have the home in any country, then suppose he is a resident of both the country, but he don't have the home in any country, or sir, in the both the country, or in the both the or you cannot determine like his you cannot determine his personal and economic relationship, then sir, either he don't have the home in any country, or guys his personal and economic relationship are not determined, then what will happen? Then guys, he will be treated as resident of a country where he normally habitually abode. Habitually abode means where normally he is staying, where he abode. So that country will be treated as his residence country. So try to understand. Second point, if the state in which he has a center of vital interest cannot be determined, or if he has not a permanent home available to him in either state, shall be deemed to be the resident only of the state in which he has a habitually abode. So where he habitually abode, in that country it will be treated as his resident. For that country he will be treated as resident. All people pay attention. For individual, how you will determine the residential status? First is, suppose he is first, how to determine the residential status? So residential status will be determined as per their domestic law only. But suppose if any person is resident of both the country, then sir, we have to check first is a permanent home. If permanent home in any country, then he will be treated as resident of that country. But suppose permanent home in both the country, then you have to check the personal and economic relationship are more closer. So in any country, his personal or economic relationship are more closer. For that country, he will be treated as resident. But suppose sir, he don't have a home in any country. Or sir, suppose he is having home in both the country, but his economic and personal relationship is not determinable, then he will be treated as resident of a country where he has an habitually abode. Habitually abode means normally where he stay. So that country is known as the habitually abode. So in that country, he will be treated as resident. Now next part. Suppose if he habitually abode in both the state or neither of them, then he will be treated as the resident of the country for which he is a national. Means he is having nationality of which country. So for that country, he will be treated as resident. And guys, if he is a national of both the country or neither of them, then his residential status will be determined by the competent authority. Due to a competent authority and settle the question by the mutual agreement. Means there will be a map. So guys, here what happened, guys, again try to understand, guys. This is the four step. First is he will be treated as resident of the country where he is having the permanent home. Suppose in the both the country permanent home, then personal or economic relationship more closer. Suppose he is not having any home, or that personal economic relationship is not determinable, then guys, he will be treated as resident of the country where he habitually abode. Suppose he habitually abode in both the country or neither of country, then guys, he will be treated as resident of the country where he is a national. But suppose he is a national of both the country or neither of country, then guys, his residential status will be this question will be settled by the competent authority of both the country. Means India and Bangladesh income tax authority, they will sit together on the table and they will determine, okay, he is a resident of India or he is a resident of the Bangladesh. Now guys, if any person other than individual, suppose for the company, partnership, firm, AOP, BOI, and if they are the resident of both the country, then guys, this question will be settled by the map, through the map only, by the competent authority. So residency shall be determined by the competent authority by way of map having regards to its poem or place of incorporation, etc, etc. So this is the, guys, you know that most IMP question for your examination, and examiner will ask you this question. Guys, suppose there is a one person, name is Mr. Rahul. As per the domestic law of the India and as per the domestic law of the Bangladesh, he is a resident of both the contracting state. But suppose in India he is having the permanent home, in the Bangladesh also he is having permanent home, but in India he is having one, suppose, business. In India his wife is a stay, so personal economic relationship is more closer in India, so he will be treated as resident of India. So that type of question may be asked by the examiner in the examination. Okay, so guys, this is the most important article. Article number 4 is related to the residency. Again I am revising. Article number 4 is related to the residence. How residential status will be determined? That is as per domestic law only. Now guys, if any person is a resident of both the state, then there is a tiebreaker rule. And how this tiebreaker rule will apply? First is you will see the permanent home. So in any country, permanent home, resident of that country. But permanent home in both the country, then economic and personal relationship more closer. Suppose he don't have the home in any country or economic personal relationship is not determinable, then habitually abode. Habitually abode in both the country or neither of country, then national. National of both the country or neither of country, then we have to check the MAP. MAP means mutual agreement procedure. You got my point or not? Yes. Now guys, in the DTAA topic, double taxation avoidance agreement, just check your question bank. And guys, in the question bank, if you will see now, in the DTAA topic, there was one question was pending. And I have mentioned that we will discuss this question in the later part. So do one thing, just check that question of the DTAA topic. I think topic number 3, it is a topic number, whatever the topic number in your, and you will check the question number. You will check the question number 3. We have mentioned here. Okay, do after MTC topic. So just check this question and check the solution of this question. Check this question and solution of this question. Just pause the video, check this question and solution. Yes, people, done with that question. Still, if you have not completed, then just pause the lecture and again read that question. Okay. Now, guys, we are going to start with the next article. That is the article number 5 is related to the permanent establishment, or you can say that PE. Now, guys, why PE concept? If you remember the DTAA topic, and in the DTAA also I have mentioned that you know that there are two concepts. One is the business with foreign country, and one is the business in foreign country. So business with foreign country is like an export. So suppose if you are doing the business with foreign country, now then your income is not taxable in foreign country because you are doing business with foreign country. But suppose if you are doing business in foreign country, then that country will charge the tax. It means if you are doing business in foreign country, then that country is going to charge. Business in foreign country means you are having the permanent establishment in that country. So for an example, guys, suppose we took one example, BB Virtuals Private Limited is our company. In the Nepal, we used to sell the lecture. We used to sell the book to the student staying in the Nepal. There is no tax in the Nepal because we don't have the permanent establishment in Nepal. But suppose we have started the office in Nepal. We have started our center in Nepal and student collect books or lecture from that center. Then our income will be taxable in Nepal. Answer is yes, because we are having permanent establishment in the Nepal. But question is that, sir, when it will be treated that one entity or one person is having permanent establishment in another country, when it will be treated as permanent establishment, or you can say that PE. So here guys, all people pay attention. So in the article number 5.1 state the basic rule of the PE and express the primary meaning of the PE. Okay, what is the meaning of the PE? So here PE exists in the following conditions are satisfied cumulatively. So if all the conditions are satisfied, then we can say that enterprise is having PE in the another country. When? First is there is an enterprise. Such enterprise is carrying on the business. There is a place of business in that country, and such place of business is at the disposal of the enterprise. Disposal of the enterprise means available for the enterprise. It may be owned or it may be rented, but must be one which enterprise has the effective power to use. The one which the enterprise has the effective power of use. So that is like that premises, or you can say that place should be available for the purpose of business, and it may be owned or rented. But guys, place of business is a fix. That is, it must be established at the distinct place with the certain degree of the permanence should be there, and business of the enterprise is carried on wholly or partially through the fixed place of the business. So guys, if all the conditions are satisfied, then we can say that there is a permanent establishment. So for the PE rule, guys, article number 5.1 says that permanent establishment means there is an enterprise like BB Virtuals Private Limited is enterprise. Such enterprise is carrying on business. We are carrying on business. Now there is a place of business in the Bangladesh, also in the Nepal, and that place is open, and it is such place of business is disposal of the enterprise, means it is available for the enterprise. And there should be something as fixed, means fixed place of the business. It's not like that one day we are having branch in the Nepal at one place, second day another place, third day another place. No, that is not called permanent establishment. So there will be certain permanency, degree of permanence should be there, and through that place, if we are doing the business, we are carried on the business, then guys, that will be treated as the permanent establishment. So guys, here PE in the OECD model as well as in the UN model, this is the basic rule. PE means there is an enterprise doing the business, and in business there is a place of business, and that place of business is available, that is disposal of the enterprise, and there is a fixed place of business, and through that place if they are doing the business, then guys, it will be treated as a PE. Now in the 5.2 they have given certain example. So what example are? As per article number 5.2, the term permanent establishment include specifically if there is a place of management in any other country, that is the PE, or a branch or an office or a factory or a workshop or a mine or an oil or gas well or a quarry or any other place of the extraction of the natural resources, that will be known as the PE in another country. So in another country, if you are having the branch, that is called PE. If there is an office, this is called PE. Factory, workshop, mine, oil, gas well, quarry, or any other place of extraction of the natural resources, that is called a PE. And guys, this 5.1 and 5.2 both are identical in the OECD model as well as the UN model. But guys, there is some differences in the OECD and UN model that we are going to discuss. So here, first point says that as per OECD model tax convention, suppose in another country, if there is a building site or a construction site or an installation project constitute the PE, if it is last for more than 12 months. So guys, in any country, suppose if there is any building site or if there is any construction site or there is any installation project, and suppose that building site, construction site, installation project, if that is there for more than 12 months, then it will be treated as a permanent establishment. But guys, UN model says something different. In the UN model, it is a wider, as it's covered the assembly and installation project also. Yes, suppose if there is an assembly or installation work, that also will be treated as the like PE. And supervisory work, suppose any supervisory activity is carried on at any place, then it will also be treated as the PE if it is continue for the period of the 6 months. So guys, can I say that this 5.1 and 5.2 both are identical in the UN model and OECD model? But here there is a difference. And what is the difference in case of the PE? OECD model says that building site, construction site, installation project can also be treated as PE if it is for more than 12 months. But UN model says that, okay, building site, construction site, installation project, but along with that, assembly and supervisory also covered. Assembly and supervisory project, that is also covered. And guys, if it is more than 6 months, then it will be treated as a PE. So here there is a difference, guys, and the examiner may ask you the difference. What is the difference between like OECD model and UN model in perspective of PE? So you will write that in case of the building site, construction site, installation project is treated as PE if it is more than 12 months as per the OECD. But UN say that along with building site, construction site, installation project, if there is an assembly and installation or there is a supervisory activity, and if it is for more than 6 months, it will also be treated as the permanent establishment. You got my point or not? Yes. Now guys, one more point. In the UN model, there is a one additional point that is related to the service PE. Service PE means, for an example, if you are giving service in any other country, and if you are giving service in any other country, then it will be treated as the service PE. So service PE, this particular article is only in the UN model, not in the OECD model. So here what this says, try to understand. UN model make a specific reference to the service PE, which is absent in the OECD model. In OECD, there is no service PE. Now in the UN model, read as follows. The furnishing of service, including the consultancy service, by an enterprise through the employee or other personnel engaged in the enterprise for such purpose, but only if activity of that nature continue within that contracting state for the period or periods aggregating more than 183 days in the 12-month period commencing or ending in the fiscal year concerned. So in this previous year, any 12-month either completing or 12-month is starting. In that 12-month, if that service is given for more than 183 days, then it will be treated as a PE. So guys, for an example, suppose in India, there is one company name is the TCS, Tata Consultancy Service. Now suppose TCS is giving some consultancy service in the Bangladesh. And that consultancy service is given through their employee or their consultant, and they visited Bangladesh. So they don't have any office in Bangladesh, but they are giving the consultancy service. And suppose in the 12-month period, if it is for more than 183 days, then TCS will have the service PE in the Bangladesh. TCS will have the service PE in the Bangladesh. But guys, this service PE related point is only in the UN model, not in the OECD model. So what UN model says that suppose for an example, if any enterprise is providing service in the another country, and that service may be provided through the any personnel engaged by the enterprise or any employees and all, and they are there for more than 183 days in the any 12-month period. Any 12-month period means, guys, like any 12-month which is starting in the current previous year or ending in the current previous year, any in the 12-month period, if it is more than 183 days, then it will be treated as the service PE. Now next part. In absence of the service PE in the OECD model, the presence has to be ascertained through the general principle under article number 5.1. So guys, in the OECD model, there is no service PE concept. So question is that how they will determine. So they are saying that for that purpose, we will see the 5.1, that is the normal basic rule of the permanent establishment. Now next part. There is an agency PE also. Now agency PE under OECD and UN target the activity done by the dependent agent of the enterprise in the source state. The recent update expanded its definition of dependent agent PE to include the instances when agent habitually conclude the contract or habitually play the principal role leading to the conclusion of contract routinely concluded without material modification of the enterprise. So guys, this is like a business connection. We have discussed the business connection. Suppose if any foreign company or non-resident appointed one agent in India, and that agent habitually conclude the contract or he play the principal role in conclusion of the contract, then that enterprise is having the business connection in India. So same clause is already there. Same clause is already there in the PE also. So suppose for an example, like BB Virtuals Private Limited appointed one dependent agent in the Bangladesh or in the Nepal. So guys, if that person is a dependent agent and he is habitually conclude the contract on our behalf, or he play the principal role in the conclusion of contract, then we will have the PE in India, or this is called your agency PE. Now next part. UN model tax convention, that UN model, only UN model has additional article, that is 5(6) relating to the insurance, which is absent in the OECD model. And as per this article, an insurance enterprise of contracting states shall, except in regard to the reinsurance, to be deemed to have the PE in other contracting state if it's collect premium in the territory of that other state and insure risk situated therein through the person. So guys, for an example, in the India, there is a one company name is Star Health. Now, Star Health is an insurance company. Suppose Star Health is having business in the Nepal also, and they have appointed the agent in the Nepal, and they are collecting the premium in the Nepal from the person through the agents and all. Then guys, it will be treated as the PE in the Nepal. So here, but this article is only in the UN model. This article is not there in the OECD model. So again, read this, what this article says, that UN model tax convention has the additional article, that is the 5(6), relating to the insurance, which is absence in the OECD model. As per this article, the insurance enterprise of the contracting state, that India's Star Health, shall, except in regard to the reinsurance, the deemed to have a permanent establishment in the Nepal, if it's collect premium in the territory of other state, means they are collecting premium in the Nepal, or insure risk situated therein through a person. In the absence of similar article in the OECD, the PE of insurance enterprise has to be determined in accordance with the provision of the 5(1) and 5(2) in the OECD model. So in OECD model, there is no article related to the insurance business. So we will check according to this particular 5(1) and 5(2). Done. Next part is related to the business profit, or you can say that article number 7. And business profit is a very interesting article number 7, or you can say that the PGBP income. So sir, in the PGBP income, which country will charge the tax? So in the PGBP income, it's very simple. Residence country will always charge the tax. But source country will charge the tax only if this enterprise is having a permanent establishment in that country. Then only that source country will charge the tax. Otherwise, source country will not charge the tax. It's very simple. Like for an example, BB Virtuals Private Limited is an Indian company. We are resident of India. So India is going to charge the tax always. But guys, we are having the income from the Nepal. Suppose we are like selling the lecture or books in the Nepal. Then guys, if it is just an export, then obviously Nepal will not charge the tax. But suppose we have started a branch in Nepal. We have started our office in Nepal, and through that office we are earning the income. Then Nepal will charge the tax or not? Answer is yes. Nepal is going to charge the tax. Nepal is going to charge the tax because there is a permanent establishment in Nepal. So in simple word, article number 7 is related to the PGBP, and this article says that normally your residence country will charge the tax. Normally, your basic rule is your residence country is going to charge the tax, but source country may charge the tax if there is a permanent establishment in that country. So just see here what is written. Business profit of the enterprise can only be taxed in the residence state. Right of source state of the tax business profit of the enterprise only exists if there is a permanent establishment exists in its jurisdiction. So if PE is there in the source country, then source country will charge the tax. Otherwise, your residence country only going to charge the tax. Now guys, there is a one concept is called your FOA rules. FOA means force of attraction rule. Now what is the force of attraction rule? Try to understand. I will explain you with the help of one example. You will able to understand. So guys, suppose in the USA, there is a one company name is a Tesla Inc. that is located in USA. Now Tesla is having one subsidiary company in India, and that subsidiary company name is Tesla India Limited. In USA, there is a Tesla Inc. In India, there is a one company name is a Tesla India Limited. Is the one company in India, Tesla India Limited. Now guys, what happened? You know that. Or I can say that, or wait a minute, I can say that Tesla started a branch in India. Tesla started a branch in India. So can I say that branch is a permanent establishment? It's very simple. Branch is a permanent establishment. That is very simple. Now guys, Tesla Inc. is a US company, foreign company. They are having the branch in India, so it is a permanent establishment. Now whatever the car is sold through the branch, and whatever income is generated by the branch, obviously that income is going to be taxable in India. So branch is selling the car in India, the Tesla branch, and they started branch suppose in the Pune. So they started their first branch in the Pune, and Tesla is selling the car through this Pune branch. Then whatever income is there, that Tesla Inc. will pay the tax in India, because this is a permanent establishment and permanent establishment in India. So whatever income generated through permanent establishment, on that they are going to charge the tax in India. Now guys, what happened? Suppose there is a one company, name is a Reliance Industries Limited. Now this Reliance Industries Limited wants to buy 200 cars. So they order to the branch that we need the 200 car, and branch supply the 200 car. So whatever profit generated through that transaction, obviously India will charge the tax, because this is through the PE. But guys, what happened? You know that branch is there in India, but Reliance directly ordered to the Tesla Inc. Reliance directly ordered to the Tesla Inc. Reliance directly ordered to the Tesla Inc. Reliance Industries Limited is directly ordered to the Tesla Inc. that we need the 200 car. And guys, this Tesla Inc. sold the 200 cars to the Reliance. And guys, this Reliance is in India. Now question is that whatever income generated through this 200 cars sold to the Reliance, is that income will be taxable in India or not? Because here in India, this branch is doing the similar activity. And branch is doing the similar activity, branch sold the car. Then guys, obviously whatever income generated through that is going to be taxable in India. But here that similar activity is performed by the holding company, or you can say that main company, USA. And this company is this parent company directly sold the car to the Reliance. Then sir, is this income will be taxable in India or not? Guys, in the UN model, it is mentioned that yes, it is going to be taxable in India. It is called your force of attraction rule. It is known as the force of attraction rule, because whatever your PE is doing now, if similar activity is performed by this company, then guys, this income is going to be taxable in this particular source state in the UN model. And UN model says that force of attraction rule, and even that this company sold car directly to the Reliance, then also this income is going to be taxable in India. That is as per UN model. But OECD model says that no, it is not going to be taxable in India. So here try to understand business profit. Now, as per the OECD model tax convention, once a PE is proven, source state can tax only such profit as are attributed to the PE. But UN model tax convention amplify this attribution principle by the limited force of attraction rule. Now, force of attraction rule implies that when a foreign enterprise set up a PE in the state of source, that is in India, it brings itself within the fiscal jurisdiction of that state, that is the state of source, to such a degree that profit that the enterprise, that US Tesla, derived from source state, whether through the PE or not, can be taxed by the source state, means it can be taxed in India. You got my point or not? Yes. Now next part is article number 7. Next part says that as per article number 7 of the UN model tax convention, if enterprise carrying on business in the other contracting state through the PE, then profit of the enterprise may be taxed in the other contracting state, but only attributed to that PE. Or second is this related to the force of attraction rule. Sales in that other state of the goods or merchandise of the same or similar kind as those sold through the PE, or other business activity carried on in that other state of the same or similar kind as those affected through the PE. You got my point or not? So it's very simple, guys. Here UN model says that suppose for an example, PE is selling the car. So this income is taxable in India, it's okay. But guys, if head office is also selling in car, that similar activity is performed by this enterprise, then that income will also be going to be taxed in India. That is as per the UN model. Now next part is related to interest. Okay, sir, on interest, which country will charge the tax? So article number 11 is related to the interest. Now what this article says. Paragraph 1 provide the right of residence state to tax the interest. So resident country will always charge the tax. Suppose for an example, I am a resident of India and I have given the loan to the person located in Bangladesh. So India is a resident state and Bangladesh is a source state. So resident state will always charge the tax. But guys, however, paragraph 2 also confirm the right to source state to tax the interest. Source state can also tax the interest. And generally the interest is taxed in the source state as a given rate on the gross basis. So source state will charge the tax on the fixed basis like 10% or 12% or 15% or whatever percentage. Source state may charge on the gross basis, means any expenditure and all is not allowed. However, if it is beneficial owner of interest is a resident of other contracting state, then tax so charged cannot exceed the specified percentage of the gross amount of the interest. Now OECD model specify the percentage as a 10%, but UN model leaves this percentage to the established through the bilateral negotiation. So guys, what happened? Because suppose on the interest income, which country will charge the tax, source country or residence country? So guys, normally residence country will charge the tax always on all type of the income. Resident country is having the power. Okay, we will charge the tax on all the income. If you are resident of that country, then your global income is taxable. But here on the interest, source country can also charge the tax. But guys, OECD model that says that source country can charge the tax maximum 10%. But in the UN model, that percentage is not written. In the UN model, they have given just a blank space. You decide, na. Suppose Modi ji and Meloni ji, they are sitting together on the table, then they will decide that, okay, on the interest that source country will charge the maximum tax at the rate of 10%, 15%, 20%, whatever. So in the OECD model, they specifically mention that source country will charge the tax at the rate 10% only. Resident country will charge the tax according to their law. But guys, in the UN model, there is no percentage is given. So no percentage is given. It means guys, they will decide on the bilateral negotiation basis. Okay, done. Now next part. It may be noted that definition of interest in both the model is similar. It means income from the debt claim of every kind, whether or not secured by mortgage or whether or not carrying a right to participate in the debtor's profit. And in the particular, income from government security and income from bonds, debenture, including premium and prices attached to such security, bonds or debenture. But penalty charges for the late payment are not regarded as interest for the purpose of this this article. So penalty charges for the late payment are not covered as a interest. Done. So this is the article number 12. Sorry, article number 11. Now guys, article number 12. 12 is very interesting. 12 is related to the royalties. On the royalties, which country will charge the tax? So guys, resident country always have the right to charge the tax. You know that. In the article number 12, royalty income, only resident country will charge the tax. Source country will not charge the tax. That is mentioned in the OECD model. OECD model says that suppose for an example, you are a resident of one country and you are getting royalty income from another country. Then that source country will not charge the tax. Source country will not charge the tax. Only resident country will charge the tax. That is given in the article number 12 in the OECD model. But in the UN model says that resident country will charge the tax, but source country may also charge the tax. So it is right is given to the source country also. Okay, source country will also charge the tax, but there will be a certain percentage. Like if you remember 115A in the Income Tax Act also, suppose if any non-resident having the royalty income from India, then you know that 115A says that there is a 20% tax on royalty FTS. So source country is also charging the tax now because we follow normally UN model. So guys, here in the article number 12, OECD says that only residence country will charge the tax on royalty income. Source country will not charge the tax on the residence on the royalty income. But guys, UN model says that yes, source country can also be charged, but at a prescribed percentage on the gross basis. So what this article says, try to understand. As per OECD model, royalty arising in source state and beneficially owned by the resident of resident state are taxable only in the resident state. However, the UN model provides that the royalty may be taxed in the residence state. Hence, UN model departs from the principle of exclusive right of tax provided in the residence state. In the thus under the UN model, the source state may also tax the royalty. However, if the beneficial owner is a resident of resident state, the tax charged by the source state cannot exceed the specified percentage on the gross amount of the royalty. So guys, they can decide on the negotiation basis, okay, 15% or 20% tax will be charged by the source country and resident country can charge the tax. There is no issue at all. Now, definition of royalty under the OECD does not include the following. So guys, in the OECD model, definition of royalty is not covered the following. What they have not covered? One is the rental for film or tapes used for radio or television broadcasting. So rental income from the film or tapes used for radio or television broadcasting, that is not covered in the OECD model in the royalty. And guys, equipment rental, like rental for the industrial or commercial or scientific equipment. So industrial, commercial and scientific equipment rental, that is not covered. So in simple word, can I say that in the OECD model, in the royalty, what is not covered? So in the OECD model, one is the rental of the film or radio tapes. So film or tapes is not covered. And second is the commercial scientific equipment or industrial equipment's rental is not covered in the royalty in the OECD model, but it is covered in the UN model. Now next part is the article number 12A. Now guys, this article number 12A is related to the fees for technical service. Here it was related to the royalty. Now guys, this article number 12A is not there in the OECD. It is only in the UN model. Article number 12A is only in the UN model. It is not in the OECD model. So in 2017, the UN model has inserted the specific article pertaining to the fees for technical service. There is no specific reference to the FTC in the OECD model. Paragraph 1 provides that FTC may be taxed in the residence state. So UN model says that residence state will charge the tax, but source state can also charge the tax. Source state can also charge the tax. So here, like paragraph 1 provide that FTC may be taxed in the residence state but does not provide the exclusive right to the residence state. It means paragraph 2 established the right of country in which FTC arise to tax in accordance with the domestic law, subject to the limitation of maximum rate of the tax, and if the beneficial owner is a resident of other contracting state, the maximum rate of tax has to be established through the bilateral negotiation. So guys, basically article number 12 and 12A is similar in the UN model. OECD model says that on the royalty, only resident country will charge the tax. Source country will not charge the tax. But UN model says that both can charge the tax. And on the fees for technical service, this is only in the UN model. It is not in the OECD model. And this article says that both country can charge the tax. Resident country can charge the tax, but source country can also charge the tax. But there is a some like rate and maximum, at that rate they will charge the tax. You got my point or not? Yes, this is the article number 12A. Now guys, there is a article number 12BE also. But there may be possibility that this article is not there in your book. If it is not there, then you have to take the printout or you just have to write in your book. And this article is also only in the UN model. It is not in the OECD model. Now what this article is, try to understand. This is related to the income from automated digital service. Automated digital service. So in case of the automated digital service, sir, which country will charge the tax? So this is in the line with the royalty FTS only. And it is there only in the UN model. And this says that a resident country will charge the tax. But source country may also charge the tax. Source country may also charge the tax, but that percentage we will decide that at what percentage source country will charge the tax. So here, try to understand. In 2021, the UN model has inserted a specific article pertaining to the automated digital service or ADS. There is no specific reference to FTS in the OECD model. Paragraph 1 provides that ADS may be taxed in the resident state but does not provide that ADS is exclusively taxable in the resident state. Paragraph 2 establishes that the right of country in which income of ADS arise to tax in accordance with the domestic law. However, if the beneficial owner of income is a resident of resident state, then tax is charged by the source state cannot exceed the specified percentage, and that will be decided according to the bilateral negotiation. But what is the ADS? Automated digital service include online advertisement service, supply of user data service, online search engine service, online intermediation platform service, social media platform service, digital content service, online gaming service, cloud computing service, and standardized online teaching service. And paragraph 7 provide that the provision of article number 12b shall not apply if the payment underlying of the income is automated digital services already covered in the royalty FTS. So if it is already covered in the royalty FTS, then obviously it is not covered in this particular point in the ADS. Done. So guys, this is also like a royalty only. This is also like a royalty FTS only, and it is only in the UN model. It is not there in the OECD model. You got my point or not? Yes. So this is the article number 12b. If you want to take the printout or copy, or if you want to write, then you can write also. If you want to write, you can write also. Done, people. Now article number 30. Article number 13 is related to capital gain. So sir, capital gain, which country will charge the tax? So obviously resident country will charge the tax. So resident country is going to charge the tax. But when source country can charge the tax? Try to understand. So here guys, capital gain, which country will charge the tax? The right to tax income from capital gain may be exclusively with the residence state or shared between the residence and source state. Capital gain shall be computed as per the domestic tax law only. Now it contains rule for taxation of gain from the alienation of different asset, such as immovable property forming part of the P, ship, aircraft, etc., etc. In respect of shares, both the model have been updated and are identical. Right are confirmed to the source state if more than 50% of value of share during the preceding 365 days derived from immovable property in source state. So guys, they are what they are saying. You know that we have discussed on Vodafone case law, and in Vodafone case law we mentioned that suppose for an example, like we have discussed that suppose if that foreign country derive its value from India, then that foreign company share will be treated as that are located in India, it will be taxable in India. So in the same line, what they mention, normally your resident country will charge the tax. Always resident country will charge the tax on the capital gain. You are a resident of one country, then that country will only charge the tax on the capital gain. But source country may also charge the tax. And here guys, they mention that in respect of the shares, both model have been updated and are identical. And right are confirmed to the source state. Source state will charge the tax only if the more than 50% of value of shares during the preceding 365 days it's derived from the immovable property in the such source state. So suppose shares of that company is derive its value more than 50% from the immovable property located in the source state, then source state can also charge the tax. But this is not relevant for the examination purpose. You can skip the article number 13. Now next is the article number 14. Now guys, this article number 14 that is related to the independent personal service. Independent personal service, or you can say that the professional service. Okay, suppose sir, I am a professional. I'm not having any I'm not selling the goods and all. And suppose sir, I'm a professional, you are a consultant and you are providing service in the foreign country. So is income will be taxable in foreign country or not? That is called your independent personal service. So for the independent personal service guys, independent personal service, there is a specific article, and this is only in the UN model. It is not in the OECD model. And what this particular article says that, suppose you are a resident of India and you are a professional and you used to visit in the foreign country and you used to provide the service, consultancy service and all, then is that foreign country will charge the tax or not? So foreign country, or you can say that source country, will charge the tax only in the two cases. One is if there is any if any fixed base for you in that country, fixed base, like a permanent establishment. So there was a permanent establishment. So if there is a fixed base in that country, then that country will charge the tax. Means you are having one cabin or one small office in that country and you are providing your professional service through that office, then guys, that country will charge the tax. Or guys, suppose you don't have the fixed base in that country, but you are in that particular country for 183 days or more in the any 12-month period. So in the 12-month period ending in current year or starting in current year, so in 12-month period, if you are there for the 183 days or more, in this particular case, it will be like that country will charge the tax on your personal service, or you can say that the professional fees. So try to understand what this article says. Article 14 is only present now in the UN model. It was deleted from the OECD model. The effect of deletion of article number 14 is that income derived from professional service is now dealt with the business profit. So in the OECD model, there is no this article. So what will about the professional service? So professional service will be covered like a business profit, and article number 7 is applicable. Now next part. This article deal with the taxation of income derived by person for the professional or specified service which are offered in the source state through some presence. The income derived by resident of contracting state, suppose you are resident of India, in respect of professional service or other activity of independent character shall be taxable only in that state except in the following circumstances. When such income may also be taxed in the other contracting state, suppose for an example in the Nepal, you provided some professional service. So when income will be taxable in Nepal, in India, it is anyway, it is going to be taxable. But in Nepal, when it will be taxable, try to understand. If he has a fixed base regularly available to him in the Nepal, other contracting state, for the purpose of performing his activity, in that case, only so much of the income is attributed to that fixed base may be taxed in that other contracting state. Second is, if his stay in the other contracting state is for the period or periods amounting to or exceeding in aggregate 183 days in any 12-month period commencing or ending in the fiscal year concerned, in that case, only so much of the income as it derived from activity performed in that other state may be taxed in that other state. And guys, here professional service include the specifically independent scientific, literary, artistic, educational or teaching activity, as well as the independent activity of the physician, lawyer, engineer, architect, dentist and the accountant. So in simple word, you can say that the professional service. So guys, if it is a professional service is provided, then which country will charge the tax? You will say that resident country. But source country may charge the tax in the two cases. Either there is a fixed base in that country, source country, or that person visit and stay in that country for the 183 days in any 12-month period. Then that source country may charge the tax on the professional income. You got my point or not? Yes, but this is covered only in the UN model, not in the OECD model. So for the OECD model, we will check the article number 7, that is the business profit or PGBP income. Done. Now next article is article number 21. Article number 21 is very simple, sir. What about the other income? Like income from other sources and all. What about the other income? So here next part is the other income. It deals with the taxation of item of income which are not specifically taxable under any other article. Key differences are as under: OECD approach envisages that the exclusive right of tax is with the residence state. So OECD says that only resident country will charge the tax on the other income. But UN model contain an additional paragraph which provide that the source state may also tax the other income. Article 21.2 of both the OECD and UN model provide that the income effectively connected with the permanent establishment maintained in the contracting state by the resident of the other contracting state, taxation is governed by the provision of the business profit, article number 7 only. And additionally, UN model provide that the aforesaid income is effectively connected with the fixed base situated in the contracting state by resident of other contracting state. Taxation would be governed by the provision of article number 14 only. So guys, here simple point is article number 21 is other income. So other income tax will be charged. OECD model says that only residence state, but UN model says that residence state but source state may also charge. Now guys, if there is a PE and permanent establishment is having other income, then it will be governed by article number 7 or article number 7 or article number 14. So guys, in the business or profession in the other country, you are having permanent establishment or fixed base, and if that permanent establishment or fixed base, if that is having the other income, then on that other income it will be governed by the article number 7 only or article number 14 only. So article number 7 is a business profit and article number 14 is a independent personal service. Done. Now article number 23A and 23B is related to the elimination of double taxation. Guys, if there is a double taxation, then how it will be eliminated? If you remember, we have discussed that, that in topic DTAA. Okay, there are two methods to avoid the double taxation. One is the tax credit method and one is the tax exemption method. In the tax exemption method, what happened? One country charge the tax, other country exempt the tax. But in the tax credit method, what happened? Source country charge the tax and resident country also charge the tax, but resident country will give you the exemption. That is credit. So that is called tax credit method. So tax credit method means source country will also charge the tax, residence country will also charge the tax, but whatever tax charged by the source country, resident country will give the credit of that. Resident country will give the credit of that. That is called your elimination of double taxation. Done. So this article provides the tax exemption and tax credit method for elimination of the double taxation. After that, there are two more articles, article number 25 and article number 26, that we will discuss later after completing certain questions. So just check the questions. So guys, in the model tax convention, simple question, and you will say, oh sir, it's very simple, we can score easily 4 marks from this topic. Okay, so first question, within 5 minutes we will complete all the question. Okay, so there are total 7 questions and we will able to complete the 7 questions within next 5 minutes. First question, explain briefly the significant difference between the UN and OECD model. So what is the significant difference in the OECD and UN model? So significant difference is in the OECD model, you know that they always focus to the residence country and they says that resident country will charge the tax. But in the UN model, they give the right to the source country also. So that is the basic difference you have to write in the, that is the question number 1. Question number 2 is related to the tiebreaker rule. It's very simple. If one person is a resident of both the country, then first you will check the permanent home. If permanent home in the both the country, then you will check the like economic personal relationship more closer. If that is not able to determine or don't have the home, habitually abroad. After that, national, and after that, mutual agreement, like both country will decide. So that is the question number 2. Question number 3 is related to the what do you mean by the permanent establishment and under which article of the model convention is the concept of PE is discussed. Also explain the brief the significance of this concept in the tax treaty. So guys, permanent establishment PE article number 5 is related to the PE. Like if any enterprise of the one country can be like charged for the business income in another country only if they are having the PE or fixed place of business in that country, then only business income is charged in that country, otherwise it is not charged in that country. So this is the very simple point. So that is the question number 3. Now question number 4 is related to the royalty. Like explain the meaning of royalty under the UN model tax convention and how it is different from the definition contained in the OECD model. So guys, royalty is basically, now they have given the definition of royalty, so it is not possible to remember this definition. Royalty means any payment or cash or in kind for the consideration for use of right to use any copyright, literacy, artistic, scientific work, including cinematograph, film and all. They have given that it is not possible to remember. But how it is different from the OECD model? So I have mentioned that in the OECD model, 2 points is not covered. One is the if there is a rental of any film or tape, that is not covered in OECD, and second is the industrial, commercial, scientific equipment rental is not covered in the OECD. You got my point or not? Yes. After that, article number 5 is really explain how the income derived for any resident contracting is professional service. So guys, in the UN model there is a article number 14 and article number 14 is related to the independent professional service, independent like that service. And in this particular article it is mentioned that can normally you have to pay the tax in the source state, but in the residence you have to pay the tax in the residence state, but in the source state you are liable to pay tax only in the 2 cases. Either you are have the fixed base in that country, either you have the fixed base in that particular country, either you have the fixed base in that particular country, either you have the fixed base in that particular country, or there is a stay for 183 or more days in any fiscal year. Done. That is 12 months. Okay. So you will be able to understand. Now question number 6 is related to the what are the difference between the OECD model convention and UN model tax convention in the relation to the permanent establishment. So basically both are the same, but in the PE you know that there are 2-3 differences. One difference was in the OECD, if you remember, so in the OECD they have covered the building site, construction site, installation project if it is for more than 12 months, but in the UN they covered the supervisory also, that supervisory and assembly also covered, and their time duration is a 6 months. So that is the one difference karke, theek hai? And one is that insurance related article is there in the UN model, but that is not there in the OECD model. And this is the last question. Yeah, explain the meaning of interest and fees for technical service under the UN model. So interest covered like any kind of the debt claim is called interest, but obviously it does not cover the penalty charges for the late payment, and fees for technical service is given. It is only in the UN model. So just definition is given. So guys, this 7 are the question, and I think in your examination you can get the question mostly from that tiebreaker rule. And if you remember the tiebreaker rule and this 7 question, your work will be done. So I'm going to give you some time, 3-4 minutes, just go through all the question or pause the video and check all the question and answer. And after that, this topic we will complete within next 5 to 7 minutes. Done, people? Yes, sir. Done, sir. Done. Now, guys, let's move to the last article, and before 25 let's discuss the 26th article. Article 26 is related to the exchange of information. So guys, this article says that in the every DTAA normally they include the article number 26. So India and Bangladesh, I think DTAA we are checking here. So if you see this DTAA with India and Bangladesh, that also covered the article number 26, I think. Yeah, exchange of information, but here it is mentioned that article number 28. So guys, we are discussing about the model. So model can be changed, na? So like suppose if there is a partnership deed format, that format can be changed, na? So we are discussing about the model. In the model, this is the article number 26 is related to exchange of information. But in the India-Bangladesh DTAA, there is a article number 28 because there may be possibility they have included certain other article also as per their wish. Whatever article they want to include, they may include here. Like this article number 23, income from government and institution. There is no such type of article in the model. But India and Bangladesh want, so they included the new article. Because we are discussing about the model, like model is not possible to follow as it is. They may follow as per their convenience, na? So here, article number 26 is related to the exchange of information. Exchange of information means suppose one country asks any information related to the taxation, then other country will provide that. So that type of arrangement is there in the DTAA. So here what this article says that in order to complete tax cases, a country may require certain information which may be available with the treaty partner. Treaty partner means other country. This provide for information which may be exchanged and the manner in which such request has to be made. Now, importance of the article number 26. Now, what are the importance of this article? So, why this article? This article facilitates facilitates effective exchange of information between the contracting state. It curtail the cross-border tax evasion and avoidance, and curtail the capital flight that is often accompanied through the tax evasion and avoidance. This is particularly relevant in the respective of the developing country. So many times what happens is, suppose any businessman in the developing country, he will park the capital outside country. So guys, due to the exchange of information, if we get some information like from Switzerland, we got the detail of the account holder in the Swiss bank and all. So obviously, why it is beneficial? So it is beneficial. Effectively exchange of information can facilitate the effective information of exchange between the contracting state and curtail the cross-border tax evasion and avoidances. Curtail the capital flight that is often accompanied through the tax evasion and avoidance. This is the particularly relevant in perspective of developing country. Now, what are the next point? Similar provision contained in the OECD and UN model. So in the OECD and UN model, this article is same. Now, what will happen here? How this information can be denied or not? So try to understand. A contracting state cannot expected to provide confidential financial information to another contracting state unless it has confidence that the information will not be disclosed to the unauthorized person. So guys, suppose if there is a confidential information, then one country will not provide to another country, but they will provide to another country on the assurance that they will not share with any unauthorized person. Hey guys, you know that our CBDT is having all the name of account holder in the Swiss bank, because Swiss bank has provided all the detail of the account holder. This person, Indian person, is having the account in the Swiss bank, but our CBDT is not declaring with anyone, not disclosing, because they have signed one agreement instrument. They will not disclose to any unauthorized person. So that's why they are not giving this detail in the public. They have given some names in the public, but remaining name they are not giving in the public. Next part. A contracting state can avoid the exchange of information obligation by showing that the information pertaining to the communication between the attorney and his client, which is protected from the disclosure under the domestic law. Now guys, suppose for an example, under India, any domestic law not allowed to share the information, then guys, India will not share the information with any other country, even we are having the DTAA. But guys, lack of interest or use in such information cannot, however, from the basis of contracting state to not cooperate with the exchange of information obligation. Now guys, suppose for an example, we have asked certain information from the Switzerland. Now, Switzerland government cannot say that. No, this information is not of our use. We are not interested. You are not interested. So what happened? India is asking that information and you have signed the agreement. So you have to supply to the India. So guys, here last point says that lack of interest or use in such information cannot, however, the basis of the contracting state to the not cooperate with the exchange of information obligation. So first is one, contracting state cannot share the confidential information, but confidential information will be shared. Then they will ensure that other country will not be provided to the any unauthorized person. Second is, suppose any country domestic law put the restriction that this information cannot be shared with anyone, then they will not share with anyone. And guys, if lack of interest in or use of that information cannot be they cannot denied. Okay, we will not give you the information because this is no use of us. If information is not for your use, then it's okay, but you have to supply to the other contracting party. Now guys, article number 25 is a mutual agreement procedure. Now what is the mutual agreement procedure? Try to understand. Mutual agreement procedure is, guys, suppose for an example, I can take an example. There is a India-Bangladesh DTAA. India and Bangladesh DTAA. Now, I am from India. I am a resident of India. I am getting some income from Bangladesh. Now, suppose Bangladesh is not giving me the benefit of this DTAA. There is some dispute. There may be possibility. There is some dispute between India, Bangladesh, and Bangladesh is not giving the benefit of this treaty. Or suppose my case is something which is not covered by this treaty. My income is of some kind which is not covered by this treaty. Then what will happen? Then lawmaker says that here like lawmakers, what this model says that there will be the map. Map means mutual agreement procedure. And under the map, what will happen? India's competent authority and Bangladesh competent authority, they will sit together, and they will sit together on the table, and they will resolve my issue through the map. That is called mutual agreement procedure. So mutual agreement procedure concept says that whenever, suppose you are not getting the treaty benefit, or suppose there is a dispute, so that dispute will be resolved through the map. So here, try to understand. Where taxpayer believe that the treatment by the contracting state or states, means Bangladesh, is not in accordance with the provision of the treaty, tax treaty, competent authority of both countries should endeavor to resolve the conflict through the bilateral negotiation, and this would take place as follows. Now they will request, who we can request the map, request for the map. So OECD model says that taxpayer can make the request to the either contracting state. So he can request to the any contracting state. Taxpayer can request to the any contracting state for the map. Now time limit. So 2 years from the date when the all information required in order to case need to be provided to both the state. So all the information is given from that day to within 2 years they will give the judgment. Now, who can request for the arbitration? Arbitration must be requested by the person who initiated the case. But suppose, sir, for an example, they are both country competent authority is not getting any conclusion, then there may be an arbitration, and that arbitration can be requested by the person who filed the case, or you can say that the who initiated the case. Now departure from the arbitration, can he like come out from the arbitration? He says that no, I don't want from the arbitration. Is it possible? Answer is no, there is no specific provision. But guys, in the UN model, alternative one is taxpayer has to approach to his resident country. So if you are India resident, I am India resident person, I am having income from the Bangladesh, so I will request to the India for the map. Or second alternative is reference to the arbitration process directly as a part of the map. The decision arrive its binding unless person directly affected does not accept it. Now arbitration may be, this is all for alternative B, arbitration may be initiated if competent authority are unable to reach the agreement on the case within the 3 years from the presentation of that case. Now arbitration may be requested by the competent authority of either state. Once such request is made, taxpayer will be notified, and competent authority may depart from the arbitration decision by the agreement within the 6 months after the decision is communicated. So guys, here like there is no need to remember that, but basically you just have to remember that what is the map. Map is a mutual agreement procedure. Now if you wish to read about map in the detail, then you can check our income tax websites. Guys, lots of information are there. Lots of information are there. If you are having the time, sir, we don't have the time, sir, we have examination. So if you have the time now, then you can see here. There are lots of information related to the mutual agreement procedure. This is called your map. So India map profile is given here, like where you will make the like application, how this map will work, to whom you have to make the application. Everything is given here on the income tax website. If you have more time, you can do it. Okay, now guys, this is the completion of your topic, model tax convention. Now in the model tax convention, some article, that article number 4 you have to remember, article number 5. So you can mark the IMP article, that is the one is the article number 4, article number 4. Article number 5 is related to the P, you have to mark as IMP. Article number 7, business profit, you have to mark as IMP. Article number 7. Article number 11 is related to the interest. Article number 12 is related to the royalty. And article number 12A is related to the technical service. So that you have to mark as important. Article number 14 in the UN model, mark as IMP. Done. And last, exchange of information, article number 26. Done. This much you have to do. Okay, now guys, in the article number 1, there is something is pending, that is related to the fiscally transparent entity. If you wish to read it, then read it, otherwise you can skip it. You will not able to understand this concept. What is this? Basically I am saying that, suppose for an example, like this DTAA or convention is applicable to the person who is the resident of one country or both the country. Now what about the fiscally transparent entity? Fiscally transparent entity, there are two type of entity. One is the fiscally transparent entity and one is the opaque entity. Like a partnership firm. Guys, if I talk about the partnership firm na, then just tell me, partnership firm in India is a opaque entity. In the partnership firm in India is a opaque entity. So suppose this is the firm. Firm and partner are different in India. Na? Firm pay the taxes in the different way. Partner pay the taxes in the different way. So firm and partners are different. Firm and partners are different. Firm and partners are different. Now guys, firm and partner are different because we treat as a opaque. Firm is different, partner are different. That is opaque entity. Now what is the fiscally transparent entity? Fiscally transparent entity means many countries don't treat firm as an entity. They says that only partner are the entity. That is called your fiscally transparent entity. Fiscally transparent. Transparent means direct, like glass is a transparent. Glass is a transparent. This calculator is opaque. You cannot see what is there. So that is called opaque. So guys, in India, partnership firm is a opaque. Partnership firm is a opaque because firm and partner both are different. But in the some country, here it is a fiscally transparent entity, means there is no, they not constitute as a firm. They will only treat as a partner. So guys, what happened? For an example, suppose for an example, there is a one firm and that firm is having the three partner A, B and C. Now guys, this firm is having the three partners. Suppose firm is located in USA. And firm is having the three partner, that is A, B and C. Now suppose A and B, this both are resident of USA and that C is a resident of Japan. Now if we see as a opaque entity, then we can say that firm is located in USA, na? So firm is treated as resident of USA. But guys, here if suppose there is a transparent entity, then there is no firm, there is partner. So here question is that is this firm will be treated as resident of USA or not if there is a fiscally transparent entity? Then here this model like says that this firm will be treated as resident only to the extent that partner are resident of the USA. So partner are resident of USA and suppose they are equally share the profit, that is 1/3, 1/3, 1/3. Then guys, this firm income 2/3, for the purpose of 2/3 income, this firm will be treated as resident, and for the other income, that firm will not be treated as resident of the USA. That is called, your concept is called fiscally transparent entity. If you are able to remember this or understand then it's okay. Otherwise guys, it's okay. Done. So this is the completion of your topic, model tax convention. Now guys, only one small topic is there, that is related to the latest development in the international taxation. So that is also I am going to update here. Okay. So thanks a lot people. That's enough for today from my side.